Commercial real estate rarely is the direct cause of a financial crisis, but it is often a major contributor to the financial stress that results. Commercial real estate is where we work, where we shop, and where we relax. Banks overextend themselves by lending on commercial real estate. As values rise, there is greater confidence that those loans are safe, investors make more money, and there is a natural feedback loop that leads to more loans into commercial real estate, more equity, pushing prices higher and higher. And eventually, of course, people realise those prices are not sustainable. Something elsewhere probably happens that triggers a correction in the market. And at that point, lenders can realise that actually what they thought were relatively safe loans at relatively low loan-to-market values are actually now underwater. The word bubble is a great word to describe what's going on, but not a very good word to analyse what is going on. You can't predict when a bubble will burst. If you think that a bubble is irrational pricing, it is not possible to rationally predict when irrationality will end. There are several key recommendations in our report. The first is that you can't manage anything unless you understand what's going on. What we need is to have a national database of commercial real estate loans. And that should be accessible to the regulator, to lenders, and to academics and the public who can support the market by giving advice and providing analysis. The second most important recommendation is that we need to address the deception that arises from the concept of loan-to-market value. We use loan-to-market value as a measure of commercial real estate lending risk. It's actually a very poor measure if one looks throughout the cycle. The way we do that is to introduce this concept, this metric of long-term value. So it is in essence market value, but we strip out the impact of the position in the cycle on that value. The third is that we are suggesting that the regulatory restraints on a market should operate like governors rather than switches. So rather than actually saying that the market's rising too much, we must suddenly apply further capital requirements at this stage. We should have a regime which, at the beginning of the cycle, outlines in advance how the capital requirements will increase over time as the market rises. So what are the key takeaways from this conference? Well, in relation to the vision, these ideas have been put together by people from the industry. They now need to be taken forward using the rigour of academic research with improved ideas, refined ideas, and of course the academic world understand the value of data, so support for the database would be very important.